Managerial Accounting Example 5B. Please read and be familiar with this example, and we'll go ahead and dig in. This is an example of, we're going to do a budgeted income statement, and here we're given production details about what it takes to make the units that we're going to make and sell, and we're going to turn that into the budgeted income statement. And then we're going to compare the budgeted income statement to actual results, which are given here. And then we are going to sort of pull apart the differences between the budget and the actual and see why the company did better or worse than was expected. What I'm going to do, and this will be important and we'll see as we go through the rest of the example, I'm not simply going to put the dollar amounts here, but it matters how much input we use. As we go forward, pulling apart our flexible budget and looking into the variances for direct materials and direct labor, one of the things that we want to be able to do is understand the inputs that went into our product. So I'm going to have a column here for dollars per input and inputs per unit. And then we're going to translate into dollars per unit. And we'll see what that means as we go forward with our budget. So let's look at our budgeted revenue. Here we're told that our cookies sell for $25 a piece. And the units here is going to be there's one cookie per cookie, which is going to sound a little bit silly for now. When we go to the other things, we'll see why this makes sense. So our dollars per unit is going to be $25. And we're going to say 40,000 units is what we're going to sell. If I could type, that would make life easier. 40,000 units. And so our budgeted revenue is going to be 40,000 units times $25 per unit, or a total of $1 million. All right, now let's look at our variable costs. The first thing we're going to look at is direct material, and in this example, it'll just be the dough. So here's what we're going to do. Our dough is in pounds. And what we're going to say is that the dough that we use costs $5 per pound, and there's 1 pound per cookie. So our direct material cost in dough per cookie is $5 per unit. And so our total direct material cost should be $200,000. Direct labor, we know that our direct labor is supposed to cost $12 per hour, and we're supposed to use 1/4 of an hour per cookie. So our dollars per cookie is going to be $3 per cookie of direct labor. And so $3 per cookie times our 40,000 units. Our direct labor should cost us $120,000. Variable overhead, we're told our variable overhead is $1.50 per cookie, 1 unit each. And so this should be $1.50 per cookie. Total variable overhead should be $60,000. Do we have any other variable costs? Yes, we have sales commissions per unit or per cookie. 125, 1 cookie per cookie, $1.25 a cookie. Total sales commissions should be $50,000. Those are all the variable costs that we have. And we can sum up our variable cost per unit. $10.75 per unit, and in total $430,000. So that gives us a contribution margin $14.25 a cookie, or $570,000 in total. Then we're told our fixed cost, we've got fixed manufacturing overhead of $140,000. What else do we have? Advertising of $62,000. We've got rent for $120,000 and depreciation of $40,000. So we've got total fixed costs of $362,000. And so our net operating income, we subtract $362,000 from $570,000, and we get a total budgeted net operating income of $208,000. So that's requirement 1, a budgeted contribution format income statement for the company for the year. And all we've really done here is we've taken the data that we're given on a per unit basis for the inputs that we have and translate those into dollars. So this is not terribly different from what we did when we came up with our budget in the previous example.